What do you think the data tells us at this point, Steve?
You know, we could be seeing some of the Delta variant stuff creeping in. I'm ultimately optimistic about all this, Melissa. I think it's going to happen, and it's happening. I just don't think anybody has the right metric to benchmark the reopening of a pandemic against. I mean, I don't know where you go back to 1918. That was a very different economy. Plus the idea of the amount of fiscal stimulus and, of course, monetary policy stimulus that's out there. I don't think anybody knows what the right thing is to expect here. I think by now some people thought we would have been off to the races and not looking back over our shoulders. Suddenly we are. I think that has an impact. And when I look to tomorrow's jobs report, I think there may be some of that in there. We're looking for 850,000, but some of the high-frequency data I look at kind of comports with the Bank of America idea that maybe there is some slowing. It won't be as bad as May, but may not be as good as June.
So, Steve, it's Steve Grasso. Glad to be with you. So now you and I have had conversations over the last couple of years based on the word transitory. Where do you stand now? This has to be so perplexing for everyone in your field, in your space, and you watch this on a day-to-day basis. What do you think about, A, the 10-year and the word transitory and how Chairman Powell has been dealing with this?
So I want to give you a full answer on that, but Steve, I just want to just tick off one aspect of this, because one of the things I have been I'm going to say most surprised about is that the inflation problem did not matter tremendously to companies. I think that's one of the most interesting aspects of this whole inflation story. When you look at profits, and what we did is we chronicled almost every comment together with Robert Hum and Nicholas Wells on the CNBC data team, every comment made in an earnings call about inflation, and we looked at how those companies did. They largely did well. So you could have predicted this inflation, but I'm not sure you would have made money betting against companies in that regard. So put that to the side. That's one aspect of it. You asked me about the transitory nature of this. I think a bulk of it is indeed transitory. I think the idea that, for example, OPEC volume or output is not back to where it was before the pandemic. Airline fares, they fell way down. They've been coming back, but they're sort of in line with where they were before the pandemic now. So that's part of it. The question that's not answerable right now is, I think we're sort of on the cusp right now of if an inflationary mindset sets in. You get wage demands that, because of higher inflation, that lead to higher inflation down the road and rising prices. I don't think we're there yet. I think if some of these things edge off, you saw copper edge off, you saw lumber come off. I think that once we get, two things have to happen. First, we have to restock the shelves of the goods that are out there. And then we have to get back the inventories. That's something we didn't really think about. You look at like car inventories. Inventories across the board are well below where they were. It's just a two-stage restocking process to get back to the pricing dynamic that we had before the pandemic.
The cars are an interesting point, Steve, although part of that is chip shortage related. In terms of wages, what we've seen, I think, in a lot of earnings report is wage inflation and the need to pay, the anticipation of increased labor costs into the back half of the year. I mean, we heard that from General Motors, we heard that from an Uber and a Lyft and so on and so forth. Could the silver lining of a Delta-induced sort of speed bump in this economic recovery is that the economy has time to work out these kinks in terms of shortages, in terms of inflation, whether it's transitory or not? There's more time to sort of work through the issue.
There is, Melissa, but you sort of nailed my main area of concern, which I hadn't said before, which is this. In one scenario, wages go up along with inflation. Inflation drops and wages remain high, and we're in good shape. Here's the problem. Right now, when I look at real earnings, in other words, inflation-adjusted earnings, they are not keeping pace with inflation. So what has to happen is employees have to go back to their bosses and say, you know what? Thanks for the raise, buddy, but it's not enough. And that's where you get an inflationary dynamic. So I want to see the rate of inflation begin to come down and keep those wages high, and then people will be better off. One other aspect of this, which has been interesting to me, and I don't think we know fully what the story is, but you guys were talking about tech early. This rise of inflation should create a premium for productivity-enhancing technology out there. I think you're seeing some of that in the trade that's out there, in the purchases, in the numbers, in the earnings. But I think this continues where the premium for companies right now is to find ways to use technology to bring down labor costs and all sorts of costs out there.
All right. Steve, always great to speak with you. Thank you.
Pleasure. Thank you.
Steve Liesman. Nadine Turman, what are you expecting tomorrow in jobs report?
No, we're expecting it to be pretty strong. Although I wouldn't hang my hat on just this one number. You've seen that people are spending on services. Unemployment is still high, but we're making our way down here. I just think that this is a slow recovery. And so I think tomorrow is going to show that. I'm a little bit on the opposite end of Steve, though. I think that inflation isn't just transitory, it kind of sticks at a higher level. So it feels more inflationary than if you saw it come down and be more deflationary. So I think we do have to be a little bit careful about that. But tomorrow, for me, it's a number, but it's one of many numbers that we look at.
I mean, if they hike the price of toilet paper, I'm fully not expecting that price to go down when commodity costs come down. I think the Charmin's always going to cost more. Bono, in terms of where we are priced in the market here, do you think that we are priced in for maybe not just a Delta-induced speed bump, but all the issues that we've sort of highlighted here?
We're definitely not priced for a return to what we saw with the first go-around. And you can look at the VIX, you can look at price-to-earnings ratios, you can look at valuations, you can look at any objective metric, and I think they all tell you a similar situation. What is seemingly lost behind all of this is that you still have massive liquidity, and I really think it's that simple. We can sit here and try to parse data and make timelines, but ultimately, the Fed is the one institution that you cannot bet against. And ultimately, it just makes a lot of sense, particularly where rates are and where we are globally in terms of possibly recovering and possibly hitting a hiccup. We have all types of stresses on the medical system, and we have international relations tension with China. I really think you parse all of that, but ultimately, what has caused us to continue to levitate and trade at these levels is liquidity, and that has not changed.
You know what's interesting is when you said you can't bet against the Fed, and the 10-year yield has perplexed a lot of people, right? Why are we not seeing that rise? And I think it's all about positioning. You had everyone saying he's going to stop buying bonds. So when that happens, you're saying, I got to short him. And then when the yields did not pop or when he continues to buy them, you have to cover them. And what happens when you cover them? It sends yields back down. So I don't know if it's really an indication of inflation or lack thereof, or just positioning in treasuries.